Hello, this is 3.2 and this is perfect competition. So what is perfect competition? Some characteristics of perfect competition is there are many small firms, and then it's easy to get into, so low barriers of entry, and then it's free exit and free entry. So this means that the market sets its own price, which means that the firms cannot raise the prices. A good example of a perfect competition is a farm. Now let's go over Mr. DARP. So AR and Mr. DARP stands for average revenue. MR stands for marginal revenue. So now let's take a look at graphs for perfect competition. So we always start with the Mr. DARP and we graph the MC. So MR equals MC. So they will be intersecting. And in this graph, you see the ATC is touching the Mr. DARP, which means that this is a break. This firm is in a break even right now. To examine the profitability of a firm, we don't really look at the fixed cost, but we look at the variable cost. And we want the variable cost to be as low as possible in order to be profitable. So now let's take a look at a firm that's in the perfectly competitive market that is in a short-term profit, a short-run profit and a short-run loss. So in this graph that we're looking at, the average variable cost is lower than the Mr. DARP, which means that this firm is in profit. So let's mark out the profit points right there, the boxes. So it goes from ATC to MR, MR equals MC. So that's the profit point. So vice versa, if the average variable cost is above the MR equal or Mr. DARP line, then the firm is basically losing money, so it should shut down since it cannot cover the average variable cost. So the economic loss box would, in that case, be on top of the Mr. DARP. Thank you for watching.